Thank you for joining me. Today I want to go over Kraft Heinz, or Kraft Heinz, or however you want to call it. They've been in the news a lot lately because Warren Buffett says that might have been one of his biggest mistakes. And they have gone down significantly, or rather over 40% this year. At the time of market close, under 40%, but it's very close, 38.6%. So during a time when the market was pretty much even, slightly up, to be down 40% is quite significant. And we're going to go over why and why it's not that big of a deal. But the numbers don't make sense because I don't agree with how they're reported. So what they do, obviously, mac and cheese, ketchup, other things. And by other things, I mean, if you go to the supermarket, they're in every aisle. But they make a lot of food products. They're all over the place. So pretty big company, pretty good revenues, pretty good assets, pretty solid over the past few decades. So price is 26.26. They're up almost 1% today, or 0.75%, when the market was up 1%. So still slightly lagging behind the market, but not that bad. And they seem to have sort of stabilized. So the PE is negative 2.7%, but again, this number is completely meaningless. Dividend yield is 6%-ish right now, with a payout ratio of 59%. And how can the payout ratio be 59% when they don't make a profit? Because the number is completely meaningless. Revenue, $26 billion, pretty much even. Over the past 3 years, they made 26, 26.5, 26.3 or something like that. So basically no growth there, basically not going down either. They've grown before that, so right now it doesn't look good, but it doesn't look terrible. Earnings negative $10 billion, which is down 200%, which means they were at plus $10 billion the year before. And again, number is completely meaningless. Total assets $103 billion, total liability is $51 billion. And since Yahoo went down, I couldn't really do all the research that I usually do on the stock. But let's just say balance sheet looks amazing. An assets to liabilities ratio of 2-to-1 is pretty much where you want to be. Anything over that means they don't know what to do with their money. Anything under that means they're not really financially secure. So a 1-to-1 assets to liabilities ratio is pretty much the bottom of what you should be looking for. And 3-to-1 ratio is pretty much the top of what you should be looking for. So 2-to-1 is kind of the sweet spot. So to explain why the numbers are completely meaningless, every company reports kind of a number that they think their brand is worth, which I think is stupid. But they thought that their brand was worth a lot more than it apparently is, so they now discounted the value of their brand, and that somehow affects their bottom line. It's kind of like depreciating the house that you live in. Somehow it gets worth less and less every year, even though it's the same house. You do repairs, you kind of improve it. So it shouldn't be going down, but it's like on the books it goes down. So we have a situation where basically all the numbers that they reported are completely meaningless. To make sense of it, though, the earnings before taxes and other stuff, excluding one-time events, on the earnings was pretty much even. So they went down from 5.6 billion to 5.4 billion, which means the previous year's number on the earnings was inflated by about 100%. And now this year's number is deflated by about 300%. So either way, the PE ratio is pretty much unchanged. It's about 6 if we're going by the $5.4 billion in earnings versus the $30 billion in market value. The payout ratio is unchanged-ish. Dividend yield obviously goes up when the stock price goes down, so those two are more related than anything the company itself does. And so in the end, if we combine all the meaningless information into one solid piece, means if you're looking for growth stocks, this is definitely not the stock for you. If you're looking for a value stock, I think the PE is pretty good right now. I wouldn't be too comfortable with the safety of principle portion of the analysis, because again, Warren Buffett said it might be his biggest mistake buying the stock and or buying it so heavily. And Kraft Heinz themselves have discounted the price of their brand significantly because they apparently see the millennials, the people who are killing everything, they see them buying unbranded or store-branded items rather than national branded items, which means that the value of their brand versus a store brand is not what it used to be, which means that it could go downhill fairly quickly, especially if a recession were to hit, incomes are hit, and people would buy store brands instead of name brands. So every store has a store brand ketchup. Every store has a store brand mac and cheese. Every store has a store brand whatever Kraft Heinz is trying to sell, except for special-ish items like flavors of Velveeta and stuff like that. So I think that in a recession, this stock is not that safe. But overall, I think, especially for a dividend investor, it's on sale enough right now to where buying the stock makes sense. And for a value investor, I think that there are probably better deals out there. Still though, for the time being, I think it's a fairly solid stock. I think that it would make sense to buy it at the price that it's at right now. If it goes up much higher, I don't think I would consider buying it. Personally, I'm not going to buy it right now because I think there's better deals out there, both for dividend investors and for value investors. So I'm not buying it. I don't think it's a terrible stock. I don't think it should have been hammered as much as it has. But at the current price, that's not a reason for me to buy it. As I said, it's down almost 40% from the beginning of the year, which means it's on sale right now. But I think there's still better deals out there. So do with that what you wish. That's it for me for today. Make sure to subscribe if you haven't already. I'm coming out with more videos every day before market open. I hope you have a successful day.